Inflation is not just changing the landscape for gold, but for other assets as well. And we'll be talking about what this means for any investor's portfolio. Briton Hill is the president of Weber Global Management, and he returns to Kitco today. Briton, welcome back.
Hey, David. Thanks for having me back. It's good to be here again.
Good to see you again, as always. Last time we spoke was a few months ago. No major differences in your outlook in macroeconomics, as you've discussed with me offline. However, one of the biggest changes is, of course, the CPI print has moved up higher. With the rise of inflation comes the risk of rising interest rates. Now, that has an impact on a lot of different sectors, all the way from financials to precious metals. Let's start by talking about real estate first, because I know that real estate is one of your preferred assets. Do you think now is the time to take profits if you're invested in real estate?
It's a difficult question to answer, David, because real estate is so specific to where you are geographically. Certain areas are going to do better than others. It really depends on, are people moving in or people moving out? So I take that in consideration when I'm making my real estate investments. But like you said, the other issue we have is interest rates are really low, and especially compared to the inflation rate. CPI numbers just came out at 6.2% a couple weeks ago. It's clear that inflation is continuing to rise. Last time we spoke a couple months ago, things were sitting at about 5.5%. We have another 12% or so increase in the inflation number since then, from 5.5 to 6.2%. So eventually, if this continues, it's not looking like it's really a transitory thing, as the Fed has said. It's looking more like inflation is here to stay. Eventually, rates are going to rise to meet that. And that could be a difficult thing for investors, especially in real estate. So for people looking to get into real estate, I don't think holding cash is necessarily a good idea, because inflation is going to be eating away at that. And it's not like you're making any money in the bank. So just be very careful. It's a time where investors need to be more cautious. You need to do more due diligence, and you need to be more proactive at making sure you're getting a good deal, because the risks here now with inflation and the fact that rates are so low, the risks are far greater than they have been in the past.
Well, let me give you a statement, and let me know if you disagree with this. A lot of the real estate markets that are seeing tremendous rallies, at least here in Canada where I live, Vancouver, Toronto, some places in the US, for example, they're being brought up by not just the rise in salaries in those places, but mostly from foreign direct investment. Now, overseas investment into these real estate markets oftentimes use cash only to purchase real estate and properties. So my argument is that it really doesn't matter where interest rates go, as long as these foreign investors still have cash. Correct?
Sure. Yeah. I mean, if people are buying things with cash, obviously they're not borrowing money. But when I talk about real estate and borrowing, I'm talking about mostly homeowners. A lot of people still need mortgages to be able to afford homes, and that is where a lot of the risk lies. Anybody who needs to use leverage to acquire a property, that is where the biggest risk is. But cash buyers, of course, your risk is a lot lower, especially if you're a long-term buy and hold strategy. You're not trying to flip the properties. If you're buying and you're intending on keeping them, and your leverage is low, or if any at all, you're in a much better position, of course, than somebody who has 80% of their property value tied up in a loan.
Well, Briton, we've been living in a zero interest rate environment for more than a decade. In fact, the last time we had rates rise was before 2008. Well, we've had ticks up in the Fed funds rate, after that, but the major significant rise in interest rates, at least the fear of rising interest rates, was before 2008. And of course, we saw what that happened. We saw what that did to the real estate market back then. People had to default on their homes when their variable rates went up, and they couldn't afford to pay their mortgages. With excessive leverage, that just brought the system down faster than one had anticipated. Could this happen again?
I don't think we'll see a 2008 type correction in real estate. And mostly that's because one of the big contributing factors back then was the variable interest rates. Since then, variable interest rates aren't as prevalent. You don't see that as often, but there still is the risk that we could have a real estate pullback, and it would mostly be, I think, attributed to interest rates rising rapidly, more so than people's salaries would be rising, of course. And that would create an environment where the interest expense plus the expense of the homes are unaffordable to most people. And, if the interest rates aren't going to lower or go down so that people can afford them, then that means it's going to be the home prices that have to fall for people to be able to afford that. So I think that's the risk. I don't think we have necessarily a systemic risk for a massive real estate correction like we saw in the 2008, 2009 crisis. But there still is a risk that interest rates could rise, and that could affect property prices. However, the difference we have now is rather than a deflationary environment, which is what we had in '08 or '09, we're in an inflationary one. So the velocity of money is moving much faster. People have more money to spend, I guess, just in dollar terms, not necessarily in real terms. People have more money to spend. So that can keep prices at least more stable, potentially even rising if there was sort of a correction just because people have more money. But there still is some risk there. I just don't think it's as big as what we saw in 2008, 2000.
All right. So given that real estate is still pretty stable based on what you're telling me right now, let's move on to the other asset classes. What other asset class do you think also has the potential to protect your wealth in this rising inflationary environment?
I think technologies right now that enable people to continue doing things at home. This past year, we've seen a major transition. Now, these past 2 years, if you can believe it, COVID's been around that long. We've seen a massive transition from people being out and about, going into the office, going to hospitals. We've seen that transition to everything happening at home. And you're seeing things, like these online telemedicine companies, Teladoc, MD Live. I mean, I use those all the time. Instead of going into an Instacare or an urgent care, I just get on my phone and I have a doctor call me. So I really like technologies now that are enabling people to continue to do that, because anything that makes things more convenient for people, more convenient to live or to do things, those take off like crazy and those tend to do well. So I think what we will see is we'll see these technologies continue to develop to make it even better and easier. I mean, pretty soon we'll be able to run diagnostic testing from home. So you don't even need to necessarily go into an urgent care to have diagnostics done on you. You can do things at home and then submit that and send that in. So that's kind of a sector that I'm really watching with interest right now, and currently working on setting up a medical fund so that we can start acquiring and making investments in these types of companies. Wow. Because I really think that that's a space that will start taking off, because the technology is still in its infancy. You can only imagine where these MD lives are going to be, and these telemedicine will be in 10 years from now as more things get added to their platform. So I think that is a niche that will be resistant, or at least more resistant to any sort of pullback if we have one, because no matter what, people are still going to get sick. It's not like you can really cut back on healthcare and the medical needs that you have. So I'm really excited about this sector and watching it with interest.
Okay. Well, do you think that you're seeing capital flowing into that sector from either the private placement side or the public sector?
Absolutely. I mean, you're seeing capital flowing into all sectors right now, and that's why everything seems to be rising. And that's just an inflationary environment in its infancy. So yeah, I definitely think there is capital flowing into this. You see companies like Amazon, who's a big investor in Teladoc, and these massive companies are now putting investments into healthcare and especially online telemed. I have a really good friend who's actually running an online telemedicine company, and just the numbers they're throwing around are huge. There's massive inflows of capital, and everybody wants to buy everybody. They get multi-billion-dollar offers all the time to acquire their company, and they're just turning it down because they have so much cash. So it's an environment where there's a lot of cash. There's a lot of potential for growth. They're just waiting for technologies to develop so that they can acquire them, or they're currently working on building them out.
Well, speaking of inflating everything in the market right now, which is what we've seen in the last 18 months, people are wondering when this stock market bull run can end.
Yeah, I mean, that's everybody's big question. You've been hearing that question for years now, almost. The market's going to crash, the market's going to crash, and it just keeps going. I am cautious and nervous as an investor and as a wealth manager, especially for clients who are sensitive to a stock pullback. You need to be realistic that could happen. However, the Fed is still producing trillions of dollars. And if those trillions of dollars are getting flushed back into the economy and buying up assets, I think we spoke about this last time, David, we don't necessarily need to see a market crash for people to lose money. If stocks start stagnating, and I think Europe is a good example of this, and other markets in the world where their markets have been stagnating, but we see that the inflation rate is rising. If the inflation rate is higher than the current rate that they're getting returns on the stock market. So, if their stocks are rising 6 to 8%, but the inflation rate pops up to 8 to 10%, they're losing money in real terms. Nominally, they're seeing their investments go up, but they're not really making any money. And I think that is one of the biggest risks we'll see now. We'll see growth start to slow. and inflation will continue to stay around. Not necessarily, I'm not saying that it will go higher. Maybe it will. Maybe it'll hover around here. But I think it's here to stay for the next little bit. And if the figures, in real terms aren't making people money, there's a good chance that we could actually be losing. And that's something that I'm really worried about and trying to be cognizant of, because 6.2% inflation when average returns are about 10%. I mean, you're really not making that much money now. It wouldn't take much of a pullback and also a little bit of increase in inflation for your returns to be zero or even negative.
So, Briton, we're both millennials. Let me ask you this: a young person who's working, who has still relatively high income, what is his investment strategy? What should he do? Should he put a lump sum of money in the markets now all at once? Should he put a little bit, only a small portion of his income, and then keep averaging down or up depending on wherever the markets go? Or should he wait until he's got a bit more accumulated down the line when he's a bit older? What's your advice for somebody who's young, entering the workforce, and looking to invest right now?
Sure. Assuming that they've been fiscally responsible, they don't have massive debts right now that they need to be paying off.
And most people our age have student debts. Maybe some of them have paid it off, or maybe they have a mortgage. Let's assume no excessive credit card debt or anything like that.
Right. We're assuming that their debts are manageable, even their student loans and mortgages. They're making enough that they can easily cover those, and they have extra. I would say that they can still be taking some risk right now. Continue to pay down your debts, and maybe add a little bit more to get that paid down. So, I'm not a fan of debt. I like to pay off my debt as quickly as possible. So focus on paying off your debts and then invest. Be defensive because we're seeing economic factors at play, the inflation that we haven't seen in a really, really long time. I mean, we're talking decades. It's been since 91 that the inflation rate has been this high. So it's been over 30 years since we've really had a market like this. This is going to be new and it's going to be challenging, especially if it sticks around. So be defensive. I'm a fan of dollar cost averaging. That way you can acquire a position without having to risk it all today. Take a percentage, keep investing it. I say be diversified and pick sectors that you understand well or that you think will perform well. So for us, in our wealth management firm, we're buying medical companies, medical device companies. We spoke about that earlier. We're talking about and looking at commodities, and we're buying gold companies and mining companies to hedge for inflation. And then, broad market indexes and things like that. We just want to be as diversified as we can, as defensive as we can. It's really hard because in the past, to be defensive, you would just raise your cash holdings. But now cash is just really difficult to hold because the inflation is so high. You're losing 6.2% per year on your cash now.
This is what I'm worried about, Briton. Last time we had a significant prolonged bear market, a serious one. I'm not talking about last year because that rebounded very quickly. A serious one, which is 2008. In 2008, I was in first year university, so I was not investing or doing anything finance related. After I graduated, the markets had already rebounded. So people my age, maybe even younger, who are entering the markets, who are managing funds themselves, or are looking to enter the business, they've never experienced a bear market before. And I'm looking around at all my friends on Robinhood, and they're borrowing money, trading on margin. They don't know, or they've never experienced a major significant crash. So when it does hit, I'm just wondering whether or not the market, by market, I mean the participants of this market, the people I've just talked about, are going to be prepared, or this is just going to be a really, really bad bloodbath.
Those people are going to be in trouble. That is really what makes crises and crashes happen, is the lack of liquidity. People don't have liquidity to meet their needs and to pay their obligations. And so they have to just start dumping assets. And when everybody has to sell their assets at the same time, it just creates a mess. Like you said, it's a bloodbath. So I would definitely say avoid the temptation right now to use margin, because margin also is variable rates. So your margin interest loan, especially if inflation keeps rising, your brokerage company can overnight just up that rate. They can double, triple, quadruple your rate, whatever they want to do. Those are still variable rates. And if you have a variable rate now that you're borrowing and you lose half of your portfolio, but you're still borrowing, all this money at now a variable rate that's much higher, you can really get yourself into trouble. So yeah, I definitely see that as an issue. Day trading has a big
but haven't you talked to the traders our age, perhaps younger, the people on Wall Street bets? Diversification is for people with no conviction level. Stop being someone with no conviction. Go all in, Briton.
Yeah, honestly, David, having talked to traders our age, they scare me to death. I mean, there's a lot of risk that's being taken. And I think what people don't realize is margin rates, while high right now, they're variable. They can go higher. And if you were to lose your portfolio, and if there was a pullback, heaven forbid we do have a pullback, those traders can get really hurt because not only will they lose their portfolios and be paying interest on that, they could be paying a higher level of interest because these brokerage companies, if inflation keeps rising, they're going to up those interest rates to make money on the cash that they're loaning out. So that's a huge risk that I think these investors face, especially young people. Yeah, it's a lot of fun. Wall Street Bets and Reddit have made it look awesome and appealing. And honestly, investing is great. It is a fun thing. It's an awesome tool. But with anything, there's a lot of irresponsibility that can come with that. And I would just advise anybody and almost beg anybody that is using a lot of margin, unless you have cash in the bank that you could easily transfer in there to pay that off, just don't take that risk. I mean, not right now, at least. Things are good now, but there's the possibility that could stop and cause some issues.
Yeah, well, Gen Zs and millennials are on TikTok a lot. Finance videos are really taking off on TikTok. I don't see a lot of gold videos though on that platform. Why is it that you think gold is not really discussed as much amongst younger people?
Younger people are on top of trends, and I think that they focus on things that are trending right now. And you start hearing about it. Once a sector takes off, it's all over TikTok, it's all over social media, it's all over Reddit. And so I think a lot of it is gold has not been performing well this year. That doesn't mean I don't believe in it. I do believe in it. I believe it's an inflation hedge. But things like the general U.S. stock market and Tesla and Bitcoin and the cryptocurrency world, those are doing incredibly well. You have a lot of kids who are making a lot of money doing it, and that's great. A lot of people are making a lot of money, and that's what gets posted. When you have a company like Tesla that goes up a few 100% in a year, that draws attention. And young people who got in and early and made some money, they're going to post those gains. It's going to get other people excited. They're going to be posting about it. And then we're living in this environment now where investing can go viral. These companies can go viral, and that's a good thing, but it's also a bad thing because it draws a lot of attention to companies that could be topping out. I hear so often from my friends, they're like, oh yeah, I just bought some Tesla and it crashed, or I just bought this coin and it went down. And they tend to buy at the peaks when there's maximum attention on it, and then it pulls back and they end up getting hurt. And usually if they hold it out, things have been going well enough that if they just hold out, they make their money back in the end. But that may not happen all the time. A lot of them are just getting lucky that things are recovering. So it's something to obviously pay attention to.
So let's end on gold then. Your outlook on gold, again, you've mentioned, hasn't performed well this year. Could change, might change, who knows? What's going to change?
Right. I mean, we're seeing gold moving up from its March lows of this year. It's agonizingly slow, especially when you have the market indexes. They're up 30% or more this year. Things are up a lot. And cryptocurrencies, there's a big argument that cryptocurrency has taken all the steam out of gold. I don't know. Certainly cryptocurrencies, especially Bitcoin and Ethereum, they have the makings of an inflationary hedge. That remains to be seen how well they will do. Though. Gold has been time tested, which is why I'm comfortable with it. Central banks still buy gold, pension funds still buy gold, but now we're starting to see big institutions like pension funds adopt cryptocurrencies into their portfolio. So I think there's room for both. I like gold because it's been time tested, but this year has not been a good year. I like to use an analogy when I talk to people about this now, and it's the COVID crisis. So we knew about coronavirus in November, December of 2019. That was when first cases started happening. In January, we knew it was January of 2020. We knew it was a nasty virus. And a few people who were ahead of the curve started stocking up on things like Clorox. They started buying their supplies and things they needed. And a lot of people just looked at them and said, oh, you're crazy. There's no need to do that. You're a doomsdayer. You go stock up on your stuff. I'm going to keep buying AMC gift cards because I'm going to take my kids to the movies this year.
Right.
And, what ended up happening over the next couple of months is COVID wasn't transitory. It turned out that it was a lot worse than what people thought it was. And all of a sudden you had all these people that are like, I should probably go buy some Clorox wipes. I should probably go stock up on food. And by the time the masses got there was none to buy. And we saw price surges and global shortages everywhere. And I think we could see something similar happen with gold because it's a tangible asset. And right now we have an economic illness, which is inflation, and those numbers are rising. It's here. It's doing damage to the economy. But most people don't really pay attention and don't respond until they feel it directly affecting them. Once that inflation starts affecting them, then they're going to start looking around. And we're starting to see that, gas prices are rising. People are actually starting to talk about inflation, just like, okay, people were actually starting to talk about coronavirus. The difference is the coronavirus pandemic was a microcycle. It happened all, mostly within a few months. I know it's still lingering now, but the shortages happened in a couple of months.
All right, so gold does look like it has some positive tailwinds supporting it, but I'm just going to bring up the point you made about crypto stealing some of gold's thunder. I've heard that a lot, and I'm just curious as to what you've read or seen that has made you draw that conclusion. I'm just going to quote some personal anecdotes. My friends who are investors in cryptocurrencies, they weren't prior investors in gold before. So it's not like we saw this migration of capital outside of gold into cryptos, at least not from the people that I know. Are you seeing this from the institutional side?
Yes and no, David. There are institutions that are now adopting cryptocurrencies. And I think that because of that, cryptocurrencies are here to stay. And that's why there's a lot of talk from regulators on how do we actually regulate this. But it's decentralized finance, so it's really hard to regulate. That's why it hasn't been easy. So it's difficult to say, because I think if we saw a major market correction, institutional investors, big accredited investors who, people with millions and millions of dollars that are in bonds or other assets, I don't see them selling their entire portfolios and moving a massive chunk into cryptocurrencies. There's just too much volatility there for the appetite of those types of investors. I do see them selling bonds and other assets or moving cash into gold, however, because you got to keep in mind, these are investors who they aren't looking to make any more money. They just want to preserve the wealth they have. Cryptocurrency still doesn't have a wealth preservation movement. It's very much a growth and appreciation type of asset, because we're talking 5 to 10 to 100% swings in a day. That's going to really freak out a 75-year-old bondholder who's got $10 million in whatever asset. When he sees his portfolio going up a couple $1 million a day, he's going to want to move into something that's more stable. So it's difficult to say. I think portions of portfolios, large institutional portfolios, will continue to acquire stakes in cryptocurrencies. And as those markets grow and progress and become more sophisticated and more stable, I think more and more money will move into that. We're already starting to see that with Bitcoin. It's starting to really mellow out, and a lot of the volatility is in smaller coins. And I think over the next, decade or so, we'll start to see Bitcoin get to a price point where, a big move will be 2 to 3%, and regular moves are 1 to 2%, similar to gold. But it's just an aging market. And as it ages into itself and becomes more sophisticated, I think we'll start to see more money roll into it. But as of right now, if we had a crisis right now, I don't think we would see billions and hundreds of billions of dollars move into the cryptocurrency world like we would the gold and silver market, for example.
Excellent. Briton, I appreciate your thoughts. Excellent insights. Thank you for coming on the show today.
Yeah, thank you, David. Really good to be here. Take care.
Yeah, good to see you as always. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.